Welcome to The Significance of Wealth with Tom Ruggie, founder and CEO of Destiny Family Office. I'm Marty Salt. In each episode, Tom brings you interesting topics and guests that reflect the independent thinking and tailored strategies he uses with his own multifamily office clients, exploring the evolving landscape of wealth management and ultra-high net worth, shedding light on the large sphere of alternative and private investments, and delving into the world of collecting as both a passion and investment strategy. Ultimately, he looks at success with a broad lens that may well transform the way we all define the significance of wealth.
I'm excited to welcome Christian Garrett, a principal on the investment team at 137 Ventures, which is a $4 billion growth stage venture firm with a differentiated approach to sourcing deals. 137 Ventures has helped our firm to gain access to direct and private deals for qualified clients such as SpaceX and Anduril, which we will discuss in more detail. But first, Christian, welcome. And if you could, tell us a little more about your background, your role at 137 Ventures, and how you got started in the venture capital industry.
Yeah, no, thank you for having me, and it's a pleasure to be here. So super quick on my background. So I started my career actually as an athlete. I played college sports at the University of Kansas, played basketball there from 2011 to 2015. It was an awesome experience. Got to see the bench form for a lot of number one draft picks and NBA MVPs like Joel Embiid and Andrew Wiggins, which is great. Those guys were much better than I was.
Just out of curiosity, not to sidetrack you, but did you have any really make it to the Final Four, Final Eight,
we did.
Anything like that?
Yeah, we did. My freshman year, we went to the championship game and lost to the Anthony Davis Kentucky team.
Wow.
This was 2012. That 11-12 season, which is awesome. So I have a runner-up race, which I never wear. And then I had a bunch of other things. So yeah, it was a great experience. That's awesome. I built computers as a kid. I was a nerd the rest of my life. I had a major growth spurt in high school. And so kind of having this unexpected diversion to go play basketball was pretty awesome. And then really officially started my career after that in 2017 after playing. And so worked on the operational side, worked at some startups, worked at a multifamily office firm. My plan was to go to business school and get my MBA. It was kind of always my plan, even when I first started working after basketball. And summer of 2019, instead of going to business school, I got convinced by Justin to join 137 Ventures and been a homegrown product here. We built a relationship over that summer. I have a mentor who's at Founders Fund, Trey Stevens. I was actually co-founder of Anduril. And so it's kind of already in kind of that network. And then the last firm I worked at were actually LPs in 137 Ventures. And so I ended up meeting Justin and we built a good relationship over the summer. And as I said, he convinced me to join. And 137 is an incredible firm. Like I said, been a homegrown product here most of my career. And it's been great.
Yeah, sounds amazing. I look forward to diving into Anduril a little bit more. It's a very, very interesting company that I personally like an awful lot. But your firm, 137 Ventures, has a pretty unique approach to venture investing. If you could explain a little bit about what the firm's investment strategy is and why it's proven to be so successful to this point.
So our firm started in 2011. We spun out of Founders Fund, which I headed at, kind of that network tie. Justin, Finn and Alex Jacobson, our two co-founders, met at Founders Fund. They were there in the beginning. So this was kind of right when Peter Thiel, Ken Nosek started the firm. They sort of started initially investing their own money as a hobby and then turned it to an institutional hobby. And so this was 2007, 2008. We're there through Fund 3 and then left in 2011. And if you look at our firm, the way I like to frame it is kind of a unique approach to venture. Well, our core strategy, what we're trying to do is to say, right, our thesis is around concentration without competition. Right? Can you build large generational companies without competing as much? And I think if you look across all of our strategies, it's kind of a core focus. The initial kind of focus for the firm and our flagship funds still to this day are focused on providing liquidity to founders and execs as a way to kind of access and build positions in generational companies and growth stage venture. And so that is sort of a differentiated approach. I think most people are typically just looking to build their positions through a normal kind of growth investing strategy by trying to lead primary rounds. For us, we've kind of found a different focus and differentiated way to build those positions and build close relationships with founders through our liquidity fund or our flagship fund. That is where we really build close relationships with founders. That's where we also kind of have a unique structure and how we do venture, which I can hit out a bit later. And that flagship fund really kicks off the flywheel for the rest of the platform, because once you have those close relationships with founders, you're able to then obviously get allocations in primary rounds, kind of lead primary rounds, try to lead tender, and kind of continue to build that position. And so if you look over the years, we've built large ownership positions in companies like SpaceX, Anduril, Gusto, Flexport, Lattice. We own 1 to 5% of these businesses. And we've done that without ever having to compete on term sheets on leading rounds. Right. So you kind of have a unique approach where we have our liquidity focused strategy. We have our growth fund, our opportunity fund with just investing directly in companies. And then we do co-invest. It's our big part of our strategy where we continue to double down and concentrate more and kind of drive alpha and kind of outsize returns. And so that's kind of the platform today. But if you look, it all really started on the genesis around liquidity. And, that actually started really, the genesis of that was that Founders Fund. A lot of Facebook execs were looking for liquidity. As the first company to stay private a long time. This is 2010 timeframe. And so companies, really initially they went public, before kind of 4-year timeframe. Facebook was an anomaly. And they also, wanted structured deals, which is kind of also unique. Noah was doing these kind of structured deals as well. And so that was a genesis for thinking about, one, obviously the flagship fund's focus on providing liquidity and solving this problem, which is the bet that more companies stay private longer and the opportunity set would grow. And then on the other side, it was also kind of the genesis for creating a structure that the main fund does, which is also pretty unique.
So if I'm understanding you correctly, so what your entree has been to a lot of these companies is really in the secondary market. So working with the founders of some of these companies, but to produce personal liquidity for them. And that developed the relationship where then as there were additional raises, they would come to you for the actual raise as opposed to the secondary market. Is that accurate?
Yeah, to your point, right? The flagship fund's focus on founder liquidity, it sort of takes off that rest of the flywheel where, yes, exactly. If there's primary rounds, we can get allocations to continue to build a position. But also, we can also continue to be a sort of liquidity or secondary partner for the company, right? Because it turns out we're not just founders getting liquidity as the company scales, but C-suite, right? And broader management. Or there'll be tenders, right? Where they want to help the whole company get liquidity. Or investors, right? They be looking to sell. And so we sort of found a focus on being sort of a liquidity partner for the company, and a secondary strategy has a ton of emerging benefits. One being you can find price dislocations in the market. The second being, once again, a less competitive way to build a position, right? Everyone can compete for the primary round. We're happy to, put the same dollars to work, but just through kind of the liquidity focus. And it's another way you can access companies, right? Founders want to talk to us because it's differentiated, and we actually are a real partner for them on something. It's a lot harder to go and try to sort of put the same dollars to work in these companies and try to outcompete Sequoia or Andreessen on why a founder should take your term sheet versus theirs.
You mentioned a number of companies. Obviously, we've already talked, and we're going to talk further about SpaceX and Anduril. We're familiar with Flexport as well. Some of the companies that you mentioned, I'm personally not familiar with. But tell us just a little bit more about the investment process decision making.
Yeah. So I'll give you kind of where our investment thesis and framework stand and then kind of process. So our investment thesis is really centered around business model dynamics, less so industry kind of focus or top-down focus. We each individually and as a firm will kind of have some macro views. We'll have things in certain industries, absolutely. Sometimes we'll kind of do these exercises that kind of look at there's category winners in industry we think has some tailwinds, but overall our investment framework is around business model dynamics. And what's interesting is across all these companies I mentioned, all of those companies are core positions actually have similar business model dynamics, even though they're completely different industries. And so, our investment thesis is around what we call powers. And powers are basically sustainable competitive advantages and effectively moats, right? And we look for these kind of moats and different dynamics where these businesses get better the bigger they get. And, these are things like network effects, switching costs, economies of scale, counter-position business models, which I'll hit on some of our sort of power for investment theses for SpaceX and Anduril. We talk about those. The reason why our framework is around this is because eventually you can't control your duration. Right? It's not a fully liquid strategy in the public markets where we can have liquidity and we can control that. It's not private equity, right? Where you also have a little bit more control on liquidity, right? Whether it's through in recaps or just selling these companies because they're both profitable businesses and there's a market there. In venture, the founder controls the company, right? In venture, you're going for a larger outcome, and in venture, you're all signing up for a sort of long duration marriage. These are 10 plus year relationships, right? And so with that, you want to be in things that you're comfortable and excited about holding for 10, 20, 30 years, which means that you don't want to see the business model see erosion as dynamics change. You actually want to see it continue to get better the bigger it gets. And so that's kind of our investment framework.
Yeah, we actually we just did a raise for Elon Musk's new AI company, and talking to clients about that, they kept asking me, what's the hold? What's the hold? I was like, well, SpaceX has already been a while, and I wouldn't expect anything different from this. I think it's going to be a long-term hold. So to your point, something like that is something that you really have to purchase with a real long-term time frame, plus understanding the dynamics of lack of transparency. Which we barely even had a deck on this investment because there's not much out there on it. But it's a little bit of a different dynamic. So that will segue into kind of my next question is, what's 137 Ventures' view on early stage versus late stage companies?
Yeah, it's a good question. So our strategy, majority of the dollars are going towards the later stages. We're a growth stage venture firm. We will invest kind of in the early growth stages, so Series A, Series B, Series C, smaller dollars. We have a program called the Early Access Program. Actually, and basically it's a bucket in each of the funds, whether the founder liquidity fund or opportunity fund, where we'll kind of write smaller checks to earlier companies, build the relationship, get information, and they continue to kind of add on to those positions as companies scale. And with that, obviously, as I said, most of the dollars are going towards those later stages. And our view is that at the later stages, people are investing in us. We're not, from our standpoint, right, with our cost of capital, that's what we're focused on, right? Where can we generate returns into our cost of capital and try to close the gap between sort of risk within these businesses, coupled with obviously our conviction on the upside. And so the later stages, you just have more data, right? You're able to, not just underwrite fundamentals in businesses, but you can talk to customers. You have more of a history of kind of how cohorts have performed, how the product has evolved. You just have all the data to support the same kind of venture framework around team, market, and product. But now you actually can really underwrite these businesses and sort of put numbers to the story and put more data to the story. And that just helps you have more conviction. And I think our approach, at the growth equity side, because we have a lower cost capital than venture, early stage venture, right? We don't need to deliver 10x funds or 5x funds. It's an advantage, right? Because we can sort of just get more data and have more high conviction as we add positions. An advantage of our strategy too, as I mentioned, the liquidity side is, a lot of firms, even at the growth stage, the sort of model is slightly different than ours in that you're usually writing that large check with full conviction at some point in the company's life cycle to get your ownership targets, and then you're prorating out of the venture model. In ours, we can actually be the opposite. The dollars deployed, the amount of dollars deployed is inversely proportional with the risk profile of the company. So if the company gets de-risked, we increase the amount of dollars deployed forward. And you see this in all over companies, right? We're continuing to write to the largest checks you ever wrote in these companies at the later stages. And that's a unique advantage because the demand for liquidity is proportional with company scaling, right? So as the company scales, as it gets de-risked, then the demand for liquidity goes up, right? Because people's networks are tied to the scale of these businesses. And so that's an advantage where we can kind of start small when there's less risk and continue to add on because the demand for liquidity is growing as the company's scaling. And so we like that model better, right? It's just you have more data and you have more conviction and it's more de-risked as you're putting most of the dollars to work. And it's kind of contra traditional venture in how they sort of get to their kind of ownership targets or thinking about portfolio construction. And I think it's an advantage that we have, quite frankly.
Well, so we've talked, we've mentioned SpaceX. I want to dive into that just a little bit. We've been fortunate because of our relationship with you all to have access to SpaceX. I think we've offered it on the last 3 rounds that they've done. It's been an offering to clients. We also have included allocation in we set up a alternative investment fund called the Destiny Alternative Fund. And so we have an allocation to SpaceX there, but would love to get, and I'm sure my audience, because we're going to be sending it to people that own SpaceX, but I'm sure my audience and myself would love to get a little feedback on SpaceX. If my recollection is correct, you guys have a pretty long tenured relationship with them. You've been actively investing with them for many years. So, I'd love to know, what your thoughts are on SpaceX, where you believe the continued opportunity is, and kind of pardon the pun, but, where do you think SpaceX is ultimately going to land?
So, you mentioned our history with the company, right? So our relationship with the company really goes back to 2008. Jesse and Alex got to co-lead the SpaceX investment for Founders Fund, which was the first outside checking company. That investment was done at a $400 million valuation, I believe. The company is well north of that, as most people know, it's public. Like all things in venture, the company it exhibits the power law, and you just see that it continues to compound and continue to be a winner. And we still think it can drive pretty outsized returns even at this scale. They're really still in the early days on many business lines.
Man, it's a company which is crazy to
just crazy.
That.
It is. Even at this valuation, this scale, right? I mean, so we've continued to invest in the company. We carry a relationship as a firm. We've been investing since day one. So it's been about 13 years now as a firm, right, since we started. We continue to invest in every primary and tender for the company. We are extremely bullish on SpaceX still, and we'll continue to invest into the company and are very excited about where things are going. You look at the business today, right? You have kind of two core businesses. You have launch services and you have Starlink. And it's incredible that, not only are both growing and executing extremely well, but you also have the beginnings of some of the optionality dynamics that we thought about, years ago when investing are coming true, which is really about Starship. We never sort of modeled the economics within our models around Starship working. We never sort of model like different kind of business lines they can move into or kind of TAM expansion for launch services. And I think one of the most exciting things is like this business was exciting without Starship. That was always optionality. Now it's looking like Starship is very real and working as a platform, and you'll see them soon start doing kind of commercial gov and customer launches on Starship after they obviously start experimenting with kind of their own launches with Starlink on Starship. And so I just think where this business is and where it's going is incredibly exciting. And so we continue to be very bullish on SpaceX.
Yeah, I mean, one thing, Christian, that I've always enjoyed about our relationship and some of the data that you put out is I would consider the data that you've put together, in particular on SpaceX and Anduril, to be relatively conservative. And by that, what I mean is you're basing the formulation of where the investment return ultimately is going to be by not taking into account some of the kind of the outside extremities that could still lead to additional return. And to me, that's a little bit of a conservative nature on what would otherwise be considered obviously an aggressive investment. So I think that's very cool. We've heard a lot, especially over the past year, about a potential IPO on Starlink. Elon seems to be he's obviously close to the vest on this, but I also read somewhere where he denied that was going to happen. And I know you don't necessarily have any inside track, but do you have any thought process on is the ultimate potential liquidity event on this probably a rollout of Starlink? Is that the underlying thesis?
I mean, the company's been pretty consistent on plan. They wanted to spin Starlink out, and this is public, right? I mean, pretty consistent on this. Spin Starlink out in the next couple of years. They've been consistent on that plan. They've been consistent on the date. Like all things, there's a ton of scenarios, right, to date. And so I think what's unique about this company is that whether they spin Starlink out, whether they take the whole thing out, or they stay private a little bit longer, the company is extremely liquid, right? It's actually incredible for the liquidity for this company within the capital markets for a private company.
Yeah. Let's pivot to Anduril for a minute. So they had a pretty big announcement that came out in May. If you could maybe tell us a little bit about that. I personally love Anduril. I think it's a huge disruptor in the defense technology space. Interesting company, very cool stuff. Tell us what you guys are thinking and a little bit about the company.
Yeah. So I'll get to the CCA win and kind of from there, but just history for all issues with the company. So, Anduril started by Trey Stevens, Tom Ruggie, Matt Graham, Brian Schiff, and Joe Chen. Palmer and Joe lead their relationship back to Oculus. And then Brian, Matt, and Trey have the relationship from Palantir days. There's obviously a lot of history on kind of the formation of the company. As mentioned, our relationship with the company really started, it says, back to Palantir. We were early investors in Palantir, carried that relationship with Founders Fund. It was a real great winner in Fund 1. One of our first checks that we wrote as a firm in investments. And so we've known these guys from the Palantir days. Obviously, we also have personal relationships with the founding team. Founders Fund were investors in Oculus. So it's kind of this dynamic where you sort of see the existing portfolio as well as kind of our sort of working personal relationships leading to kind of the sourcing a next generation investment, and one that's become pretty sizable. The company fits our investment thesis and framework like we talked about, right, in a couple of ways, just to kind of tie things back. So with SpaceX and Anduril, there's some obvious and non-obvious sort of powers in our investment thesis, right? Economies of scale is one, right? Obvious, obviously as they get larger, they get better supplier dynamics, can improve their cost structure. There are fixed costs to this business. They can spread that out kind of over a larger revenue base. They continue to drive better economics for the business. There's also a unique dynamic where it's a scale benefit, where within government, the larger you get, the more the government takes you seriously, the more contracts you get. So sort of success begets success within government. And we've obviously seen that for the company. But there's some less appreciated sort of business model dynamics. One of them is they have a counter-position business model, right? So the primes have built their business and they trade in the public markets around a cost-plus business model, which means that a couple of things. One, the businesses get hammered whenever they deviate from that because they usually have cost overruns. And as I said, they trade on sort of a consistent cash flow dynamic, right? So companies trade on EPS. They're not going to take risk, right? Sort of deviate and kind of have earnings misses. And then the cost of business model structurally locks in their margins and locks in their ability to innovate and move fast because it creates perverse incentives given sort of the cost plus business model. Whereas Anduril has a firm fixed price business model, similar to what SpaceX did, where they can bid against these cost plus contracts without being cost plus. And that gives them a huge advantage. Not only do you get a structurally just higher margin because you're just selling a commercial product that they own to the government, so there's no sort of a cost plus sort of fixed margin cap, but also you can innovate much faster because you're taking your own R&D risk and you have an incentive to not waste R&D dollars, especially for a startup with those real precious dollars. And so, I've been a couple of the sort of examples of the things we look for in businesses. And Anduril is one of the rare companies that exhibits a bunch of these kind of powers within our investment thesis. And it's a company we continue to double down. We've been invested since the Series C, so 2020. And as mentioned, we continue to write some of the largest checks we wrote in the company now, and we'll continue to invest in the company. The CCA win just sort of was a really major public milestone for what us as investors have sort of been investing in and excited about for this company. And it's for them to take a step towards actually being a prime, and it's a major contract win, right? You saw them be the only startup, the only non-prime, competing against all the other primes for a major contract, which has a chance to be a $20 billion opportunity over 10 years between international and domestic. And so, I think this is a company that has a chance to get a seat at the table and become another defense prime. And that is a massive opportunity. Lockheed Martin is a $140 billion business. And I think Anduril can get there with a fraction of the revenue or a fraction of a percentage of the defense budget, given that they have structurally higher margins and a different business model. So they should also have a much more profitable business.
So I assume, as you've evaluated this and the demand for Anduril, I mean, that this potentially could be and potentially obviously is a key word, but potentially could be a huge win for investors into a company such as Anduril.
Yeah, absolutely. It's this, like I said, it sort of is a sign of the trend for them in getting a seat at the table, becoming a prime, which you mentioned just begets more opportunity, right? The government takes you more seriously as a contractor. Will give you sort of the next set of large scale programs. It showed them executing they've gotten, a couple $100 million programs of records. They've gotten, $1 billion programs of records, like the SOCOM SIP contract. And then this is sort of a next step function up, right? And so as this business continues to scale, you want to see them continue to go after sort of larger program types and contract opportunities, and they executed on it, which is exciting. And so, I think as investors, it's incredible to see the story play out, but it's also early days, right? One, they have to execute and deliver, like all contractors do, of course. And then two, like you said, it's still early days. There's a whole host of opportunities in next generation products that we're going after. And the CCA is extremely exciting and really important in solving a big problem for the Air Force. But it's sort of the next step on a long journey that mostly has a very outsized outcome.
I like the way you put it, that you're comparing like an investment into Anduril and kind of where we're going is potentially to be quote unquote prime. Is that type of a company a type of a company that 137 Ventures looks to invest in is a company that maybe has the potential. In this example, Anduril could have the potential to ultimately be a Lockheed Martin. Is that kind of a theme?
You nailed it. I mean, look, and there's kept some themes, right? I mean, Peter Thiel, which is a trope that we've taken as a firm spinning out, but Peter always says you want to invest in monopolies. They actually try to be the best businesses, and legal monopolies that the government likes, or oligopolies, or even better. And so, if you look within defense, if you look within aerospace, right, for SpaceX, or Anduril, these are industries where just structurally the government has oligopolies for various reasons. And it's rare, but once in a generation, you have the opportunity to join those oligopolies and become one yourself. And you get a ton of emergent benefits from that.
All right. So, Christian, just one last question for you. So, I can't go anywhere without hearing about AI. What is 137 Ventures' view on artificial intelligence and kind of what potentially the glide path is going to be for that?
Yeah. So, all these things, it's always helpful to have framing. And then I'll give the kind of bullish and exciting stuff. But the framing is, one thing just always remember is we've had one, AI is not new.
Right.
We have
it just seems that way.
It just seems that way. We have had, it used to be machine learning. It still is. But we've had machine learning and deep learning models in production driving value for companies and enterprise for a long time. The pricing algorithm for when you order an Uber, the matching algorithm between drivers and riders, all of those run on complex algorithms, and complex algorithms is another word for AI. And the thing that's been unique or different has been a change in architecture and then a sort of proving of a thesis around scaling laws. And it turns out there's a ton of emerging benefits and improved capabilities with a new architecture and with just huge scale. And I think that's what's been exciting. You saw this sort of ChatGPT onward kind of moment, and this explosion where we sort of saw a sort of step function increase in capabilities and thus, realistic use cases. And I think that trend is going to continue. And it's extremely exciting. But at the end of the day, these are not, runaway sentient beings that we've created. They're just, as I said earlier, it is math. It's code. It's running on hardware that we control. And it's another tool within the toolbox for not just developers to scale, right? But now this is becoming a toolbox for knowledge workers, blue-collar workers, right, for broader society. And that is what is exciting. We're kind of crossing the chasm into next generation kind of compute capabilities and use cases. And for me, that's what, I'm personally excited about is like, look, now you have the opportunity for us to realize a sort of step forward in the dream of what computing could be, right? Which it gives humans sort of augmented capabilities. Right now, every kid can have a personal tutor, right? That costs a fraction of what a personal tutor would cost and have access to all the information and tests and studies that anyone else can have. And it closes the gap, right? I think that's what's exciting. As a firm, what we're excited about is kind of two things. Look, I think, yes, the opportunity within LLMs to maybe potentially, disrupt and create kind of new industries, whether it's like third-party GPU cloud infrastructure as an opportunity, whether it's sort of next generation applications that are sort of net new applications you couldn't do before, like next generation video editing, or kind of AI for financial services industries. We've seen a couple of use cases, and we've invested in some of these smaller investments, like I talked about, our early access program, where we can write smaller checks, take a little bit more risk, and then kind of track how things evolve, because this industry is evolving fast. So it's very hard to have full conviction on defensibility of these businesses. So we've had to write smaller checks and track things. But where we've had more conviction, we want to write larger checks, are existing companies that really benefit from this technology, this tool, right? And we've seen our companies like Ramp, which is in the Opportunity Fund, and company we continue to invest and be excited about, implement AI tools to improve closing of accounting books, to improve workflows, to automate expense batching, right? And so this is work they're already doing, and now they have step function in the AI capabilities, and they were able to turbocharge their models and implement new models. We've seen this in Gusto, right? Who's able to implement AI into some of their workflows and make things easier, right, for customers. Intercom has obviously benefited from sort of having an ability to cut costs, where you can now use AI and have a sort of 10x better chatbot, be able to close tickets and customer support questions, right, instead of diverting it to humans. And that improves the efficiency kind of the human customer service base. And so that's, I think, where we're getting most excited. It's been sort of the accelerant for some of our businesses on their product roadmaps and their ability to scale top line or improve their cost structure.
Well, with that, I'm going to thank you very much for being on our podcast. And it's been a great conversation out here, a wealth of knowledge. Much appreciated.
I really appreciate it. Thanks for having me, and look forward to talking soon.
On behalf of Tom Ruggie and Destiny Family Office, we hope you enjoyed today's episode of The Significance of Wealth and will continue to tune into future episodes. Connect with us at destinyfamilyoffice.com, on LinkedIn, Facebook, YouTube, and Reddit, and recommend our podcast on iTunes and Spotify. Until next time, the expressed views, thoughts, and opinions in this episode of The Significance of Wealth belong solely to the host and/or guests and are not investment recommendations or offers to buy or sell securities or private investments by Destiny Wealth Partners or its affiliates. This podcast is for informational and educational purposes only. The funds discussed are typically for qualified purchasers, defined as $5 million of investment net worth, exclusive of primary residence.